No, I think the world's just going to continue as it is. There's going to be a lot more pollution because the corporations don't seem like they're changing. Everyone's just keen to make a profit.
Long-term investing means that you take account of all your risks, which means your environmental risk, which is at the moment should be the carbon within the portfolios, any other environmental issues, climate change. Also your social risks in terms of, which might be supply chain issues, might be to do with human capital. To me, long-term investing means that that's what you've done.
60% of members of funds, Ozpol found, would move funds based on the attitude of their funds' investment policies in things that affect climate change. But it's a big step from people saying in polling, yes, I'd move, to actually moving.
We've seen it happen with governance, so I'm confident that it can happen with environmental concerns as well.
Because humans have reached a point now where I reckon they have to change, like they have reached that point, and it's not a result of China, because they haven't been a developed country since 1855 or whatever it was when the Industrial Revolution started. It was pretty much all the increased CO2 emissions are because of Western states, and it's pretty hypocritical of us to start claiming like it's out. Like what we did results in what we have now, but yet we'll blame a country that's only just starting to get its own chance to build itself up.
Climate change is there, and particularly when we see governments starting to take some action, which they will do in whatever way, shape or form. We know there will be some action taken on climate change, and it will almost inevitably lead to costs. Those costs will be spread around, but they will have an impact in dollars and cents, and they need to be factored into investment processes.
It's been easy to dismiss climate change as a fuzzy sort of conscience issue. I don't think that will continue to be the case.
Climate change is going to happen. I believe the science personally, 100%. I think it's going to happen. It's a huge risk. You have to start from the approach that sooner or later we will tackle this. The longer we leave it, the harsher the adjustment will be, but eventually we will have to start on that painful process of transforming our economy.
For those people who say Copenhagen was a failure, let's pack our bags on climate change, my view is Copenhagen is but one step along the way.
So essentially we're going to talk about climate change investment, but I'm going to immediately say to you, put that word somewhere, those words climate change, and we're going to see that this encompasses a number of very important ideas, words like clean technology, energy security, green growth, and so on. So we're going to see that this is driven by a whole number of factors that some people feel much more comfortable with in terms of words. And in fact, there's been quite a lot of research being done now by sort of psychologists and market pollsters and so on, saying, what do people actually respond to in terms of words? And it's quite interesting. In the United States, one survey or one study is showing that over 80% of Americans respond to the notion of clean energy and paying for clean energy. The response to the words climate change is way lower. And that may be to do with the connotations of climate change sounds like restrictions, negative, carbon, all the rest of it. And clean energy sounds like let's invest, let's grow, let's have jobs, and let's make everything clean. Actually, they're all headed in the same direction. Try and bring that out. So, let's see. Yeah. So, I think this is something, to connect this whole story with what's happening in Australia, or what Australia is, in many senses, the Australian economy is about, is relatively easy, actually, because we've got to start with the heart of this whole story. It's demographics. It's the fact that there will be 9.5 billion people on the planet by 2050. It's the fact that back in 1900, there were 1.7 billion people. So this has been an exponential growth in population. And with that population growth has, of course, come wealth. And as people get wealthier, they want to spend more, they want to have a better lifestyle, and so on. So I often say to people, it's not that we're going to 9.5 billion people. They all want to sit here with you. They want to sit in this lifestyle. A lot of them do. If that's the case, the impact on the world's resources is really phenomenal. And we're seeing it already, but think about the next 50% at much higher wealth levels. It's going to be quite extraordinary. So it starts there. So when you think about this, yeah, we're talking about climate change, but we're talking about the good old demographics driving the demand for scarce resources and causing externalities, as economists call them, problems with the environment. How do we price that? How do we get to terms with it? And how can we invest in it? And the first place to say is it's energy. We can show this for water and agriculture, but the obvious point is we are seeing an explosive demand for energy, and that comes out of that vast population growth with higher wealth. Now, one of the externalities that comes with that is carbon. So I don't think it's very hard to argue that there isn't a lot more carbon in the atmosphere, because there just is. The ice core samples are pretty solid. We are at an 800,000 year high, and a higher level than we've ever seen before. This is the famous Al Gore chart where he goes up in the lift. So essentially, the theory would tell you that's going to warm. Now, there's a lot of, there's some theories, so we follow the science quite carefully because we're interested in it. And there are some scientific theories that say, yes, but there's offsetting forces in the world's climate cycle, that type of warming will be offset by others. Not many of those arguments, there are some. So what we did is we spent a long time when we first got into this on the science, and we became fairly convinced. I'm not a scientist, but as I say, I hope I have been trained to think and listen to people that are trained to do the analysis. So we remain pretty convinced, in fact, totally convinced of the story. And what we're doing is we've commissioned Columbia University, who we're quite close to in New York, to do basically a rebuttal of the climate skeptics point by point by point. And we've seen the drafts of that, and they're still working on it. We'll release that on Earth Day on April the 22nd. So, for better or worse, happy to take questions on it. We think something's really going on here. And just out of interest, that is our carbon counter clock. That is calculated by MIT. It's the only real-time greenhouse gas concentrations calculation in the world. And I know there's a little prize if you win it. If you go on our website, you can it tells you how many tons it increases a second. I'm going to tell you it's 2 billion a month. That'll make it more difficult. But essentially, the key to this competition is you better know what second they stop the clock to count it, because it's going very rapidly. So what did we do with all that? When we turned to climate change, we came up with this notion of 4 pillars of investment as we looked at it. And the first one of those is government policy. The whole thing ultimately does rest on the scientific evidence for climate. In the climate change space, you can't get away from that. The scientific evidence is crucial. But when we look at government policy, which then goes into action to deal with that, and as you're going to see, that's probably the key investment lever for the investment returns in many of these sectors, then still we've got to we start to introduce into government's calculation what we call low carbon prosperity, green growth, creation of jobs, and energy security, and I'm going to come back to that. But so the government policy is a key pillar of the drivers. Then we get into the economics, and we get into the pricing of the externality. How much damage is it going to do? How much should we pay now to stop that happening? And that becomes the carbon and energy prices. And I'll come back to whether we think it's way more than the carbon market. And then we get on to corporate responses. Some corporates respond, I'm at risk, what do I do? Some corporates respond, wow, this is a huge investment opportunity for us to develop products and services. And then finally, underlying a lot of this story is the creation of these new technologies and clean industries. So those were, the basic pillars of how we saw it. Now, just on energy security, this is probably not such an obvious one. As I flew into Australia, I was reminded you are a big net energy exporter. So the energy security issue tends to be the issue for the United States and Europe in particular, who are big net energy importers. So essentially, they're worried about their balance of payments, they're worried about their national security expenditures, they're worried about geopolitical uncertainty. And one I think that's very important, which I'm going to bring out, is the difficulty of forecasting fossil fuel prices over long periods of time due to these shocks and the large volatility that you see in the system. And I think renewables are actually underestimated because the marginal cost of renewable fuel is zero. So essentially, this energy security often plays very, very well and is very important to many people. So I think that's a driver. In Australian terms, it's there, but I'm not sure it's quite so obvious as a net energy exporter. The next thing is incentivising the economy. What about the green economy? Well, essentially, it's quite interesting. McKinsey's did some work on that graph where they looked at the increase in labour productivity during the first industrial revolution. We've then looked at the increase in required carbon productivity of economies. And if we're going to get this carbon emissions really, down dramatically without cutting growth heavily, then the carbon productivity of the economy has to improve extremely rapidly. The point is that because of the time scales, we are requiring a type of industrial revolution that's never been this fast before, really. So this is I'm talking about the economy, and I'm not talking about technology, I'm talking about the basic economy. Because the basic economy is about infrastructure, it's about water, public transport, the power grid, renewables, clean coal. These are the areas, and I'll come back to clean coal, obviously a very critical question for Australia. Now, these are the areas that we've seen the stimulus money spending in, and that's what's happened. If you look at the crisis that we saw, I think it's called the GFC in Australia, right? The global financial crisis. When I was in Australia, I remember you have to have a nickname for everything. So GFC, and I'll take that back with me, I promise. So what happened in the GFC? Well, governments responded. They stimulated. That was an easy call. We had a paper out on it in about September 2008 saying it's obvious you're going to stimulate, make it green. And, the response, a lot of people said that, of course, and the response has been pretty good. About 15 to 20% of stimulus packages seem to be green in some way. China's a very big number because the Chinese transport sector and power grid is in there. So all the public transport, fast trains that the Chinese are building was counted into that number, and I think that's fair. What is interesting to us is that it's no surprise in a US presidential midterm election that the majority of the stimulus hits now. That's the whole idea. So essentially you're seeing the ramp up in the US money hitting the economy and the clean energy markets. So, here's an example of let's not talk about, the end of the world and, let's talk about creating jobs. Let's talk about green growth. Let's talk about clean energy. And that's been a very, if you go to Washington today, if you don't mention the word jobs 3 times before you get into someone's office, they're not going to let you in. So that's a sort of big driver background. Demographics, climate change, energy security, incentivizing economies, green growth. So now we get to, okay, if we go back to the sort of the climate change universe in a sense, what does that entail for an investor? What are we really talking about? Well, in our universe, we include adaptation with mitigation. I think a lot of you know mitigation means how do I stop it happen? How do I stop carbon being emitted? Adaptation is, well, actually there's quite a lot out there already. There's already some signs of warming. That's going to get worse because of the lags are so long, and therefore I'm going to need to adapt. And what are the opportunities in adaptation? Or what do I need to do around that? So I'm just going to quickly introduce, this is more on the mitigation side, some of the big technologies that people are talking about right up front before I go into more detail. And these are called the wedges, which were done by Princeton University in 2004. And actually one of the guys that did this is on our advisory board, Sokolo. And essentially what they did in simple terms, they said, look, back then they said, let's get emissions down by 7 gigatons. Well, actually probably need to do more than that, but anyway. And how do we do that? Let's look at 7 clusters of the ways of doing it. And the first one, let's go from the right, the low-hanging fruit everybody talks about is energy efficiency and conservation. Now, I go to talks and I network with people where someone says, if you call that low-hanging fruit one more time, I'll throttle you, because if it was that low-hanging, why aren't we doing it? And I think there's some truth in that. It saves you money. Energy efficiency is positive NPVs. I mean, it's like, it's obvious, but people don't want to do it because there are upfront costs, there's some uncertainty, and a lot of it happens in buildings, and you have to structure the leases, and you have to structure the ownerships, so that's going to work. And there are financial structures beginning. In the United States, there are things called PACE bonds, where you actually just aggregate buildings up, People, the local governments issue municipal bonds to pay for it, and then you put it on the bills, and that passes down with the property, for instance. So we're going to have to see more innovative financing to get the energy efficiency markets in buildings in particular going. But it's the one, if you look at the so-called pathways to sustainability, that's the jargon, what's the pathway to low carbon, you're going to find most studies have got between 40 and 60% of the solution through energy efficiency. Now, part of that energy efficiency is what we call demand destruction, i.e. there is a change. People just don't do things. There's less demand. But that less demand can be very subtle. The typical example is that if you change if you can go in through the smart grid and control the thermostats of people's air conditioning, which is easily doable now, then essentially if you change the thermostat by 2 degrees, it's been proven, people just can't notice it. That actually can be a lot of energy. So I think this whole area is extremely interesting. Then we get on to this thing called fuel switch. Now, fuel switch is really coal to gas, when it really comes down to the big one. And, we used to talk about that, and the Europeans were trying to engineer it in their European trading system, really. That's what the price was all about. And then it got lost. It's back now big. Why is it back? Unconventional gas. So if you want to go read The Economist this week, you'll see one of the leaders, unconventional gas. Read that, shale gas in America. The Americans have enough shale gas for 300 years worth of their energy needs. They haven't been able to get it out before. Now there's the new fracking technologies. The question is the pollution and groundwater problems with those. The technologies are coming in to deal with that. Why is the gas price actually $5 BTU? Yeah, low demand, but believe me, shale gas supply is what people are talking about. It could be a game changer as the transition fuel. Obviously, 20, 30 years from now, even gas emits too much carbon. But right now, gas has a 60% less footprint than old coal, 40% less than supercritical coal. So if you're looking for a big solution right now, that really is not going to cost, it's actually going to be about, it could be even comparable or lower than coal. Then, gas is in play. So happy to come back to talk about that. Nuclear. Take it or leave it. We happen to have it in our equations. We think people will use it, but we don't believe that nuclear will get much above the 16% of world power, maybe 20% in the long run, for all the reasons of permitting and waste. Forests and soil are huge. We need to stop deforestation. And the big one, we can come back to, does CO2, does carbon capture and storage work? We simply don't know. But here's the point I'm going to make about the Australian coal industry. If I was the Australian government, I would be doing what they're doing. I would be a leader in trying to get CCS working. Because ultimately, if the dirtiest fossil fuel out there is coal, and we simply can replace it with gas, renewables, nukes, and the rest of it, and we can, there's no breakthrough there, then coal's under enormous long-term pressure unless it cleans up its act. So clean coal, I think, is really important to the Australian economy. Because it's one of the largest exports in Australia. So I think it's very rational of the Australian government trying to be a leader in the CCS R&D, and one can only hope that that is actually going to make a breakthrough. But we simply don't know how much it'll cost and whether it'll work at massive scale. So I'm going to speed up a bit now. Our climate change universe, when you really get into it, it's very deep. So that we call it cleaner energy because we include the fuel switch to gas. You've got the renewables, you've got the fuel switch, the nukes, you've got transport, sustainable biofuels. I don't know whether that's an oxymoron. We live in hope, sustainable biofuels. And I think there are some third generation out there, and I think sugarcane is arguably okay. Transport, then we move on to environmental resources. That's where you pick up adaptation, water, agriculture, and waste management. Energy and material efficiency, that's the exciting sector, advanced materials, building efficiency, power grid efficiency, enabling technologies, and then environmental services. Now, so this is really deep and wide set of sectors that we can touch in our investment universes, both, as you'll see, at a private equity and a public equity level. So my message is, it's really investable when you really think about what this sector touches. It touches the core of the economy. It touches its basically energy, water, and agriculture. I mean, it's pretty deep and pretty wide. So one of the things we do know, though, particularly about renewable energies, is they're currently not competitive with some of those fossil fuels. So what do we need? We need some subsidies. Now, this is where we can start a quick talk about the carbon price. You know, the carbon price is the yellow line. If it exists, it's meant to be going up over time, and at a certain point, it's meant to become the key driver of markets. But as we know, the carbon prices we've seen or going to see are simply not going to be very high for a number of years, and therefore they're not going to have a lot of impact. It's a long-run argument in carbon. Therefore, what we rely on is the area that we focus on, incentives and mandates at specific technology and sector levels. And they're driving what's going on in the economics of many of these technologies. Ultimately, we'd like to see technologies cheaper than fossil fuel. And is that a crazy idea? I don't know. It's not as crazy as it may sound. Some of the promising solar breakthroughs, and there still are people dealing with solar technology breakthroughs, are talking about below coal at some point. But, you know, we'll see. So when we look at the cost-benefit analysis, though, we often get stuck on that chart. You know, I'm paying a subsidy. You know, I could have done coal cheaper. Oh, you know, whatever. But we actually don't think they really capture all the costs and the benefits. On the cost side, you know, you're going to have to often scale up your grid. You may need storage for intermittent renewables and so on. But on the other side of the benefits, there's two really big benefits at the bottom. They're rather technical, but I think they're very important, and that's why they haven't got a lot of coverage, because they look a little technical. The first is called the avoided merit order of replacing expensive fossil fuels during peak hours. So what that basically means, if solar shines, if the sun is out during the peak load, you don't fire up your gas peakers. Gas peakers are very expensive to run. So the German Environment Ministry did a study of the cost of their feed-in tariff regime and concluded that the avoided cost order merit run totally paid for the feed-in tariff on its own. It was a controversial finding. People pushed back. But we think it's an extremely interesting area that the wider benefits of these renewables are not being looked at. And the second one is the one I've already mentioned. How do you value the fact that once you built a solar and wind plant, the marginal cost of the fuel is zero? That's the point. It's renewable. It's free. So essentially, you can structure power price agreements. You can structure feed-in tariffs to give deliverable returns that are known. Now, when I come to talk about asset classes and infrastructure, that's an interesting idea for investors. On the other side of it, if I'm a utility, a lot of the big utilities, I don't know whether they believe in climate change or not, but they certainly believe in diversifying their fuel source, and they're rather attracted to a known price. So what about the prices we're dealing with? Well, you know, in climate change or in energy, there's not one price. Everyone talks about the oil price, but that assumes that the correlation of gas and oil are going to come with it, and they sometimes don't. So oil drives transport, it drives some of the heating markets. Gas is really going to drive the electricity markets, as is coal. Now, what we find interesting is that, having said that, if you look at the correlation of the public equities in the renewable sector, they certainly respond to oil prices. There's just no doubt about that. So here we are, sitting at the low point, or just coming out of the worst recession in 60 years, at $70 a barrel. And in real terms, that's quite strong. So peak oil. I think the arguments for peak oil that we're in it's probably started maybe a year or two ago. People are arguing about whether the recession has pushed it out. But within the next 5 years, the high-quality research I've seen says we're in peak oil. We're going to find it extremely hard to replace what's running off. At the same time, as we know, there's lots of uncertainty in the Middle East. One point I would say is I'm pretty sure the next time the oil price gets to 150, I think this story is going to be quite easily accepted. To you as investors, I'd say at that point, whoa, you know, price earnings multiples might be reflecting that. So just as an investor, you know, remember, we're meant to be buying low and selling high. So essentially, right now, there's a fairly stable oil market, but look out, oil prices are going up. Gas price is not so certain because of this shale price supply, but they will respond to any spike in oil. And the interesting one to me is coal. I mean, will coal respond to oil, or again, is the supply of coal so dramatically possibly high through Australia and South Africa that it won't. Or secondly, the constraints on coal mean it won't because people aren't buying it so much. But I think oil is still going to play a large psychological role in the next 2 to 3 years. So let's talk about policy. This looks a little bit complicated, but I'm going to make one simple point. Emissions targets and carbon prices are at the top of our temple. They're meant to be where we're all headed. They're meant to be what we've heard. They're like level playing field, not picking winners. It's the right thing to do. As I say, the problem is it takes quite a long time to mature that market. And if you're a financier, unless you can hedge it and unless you've got long-term visibility on it, you can't use it in your project finance spreadsheet. So to be honest with you, the only carbon market in the world, in Europe, never got past 2012. So you go ask a utility whether they seriously put the carbon price into their coal models or not. It's uncertain. If we could have had Waxman-Markey, which had a minimum floor price going out 40 years. So you really knew what the minimum price was 40 years from now. That was sort of interesting. But, whether we get that, I don't know. So what we actually feel is going on is we're left with these mandates and incentives. The mandates, renewable targets, RPS, RFS. The sector and industry-specific targets. And underneath those, the incentives that drive them. Feed-in tariffs, renewables certificates, loan guarantees, tax rebates, auctioning and subsidies. This is where the government money is going to leverage the private sector, going back to that gap in the financing costs at the moment. Our view is at the moment what drives investors is in the middle there. The top is not doing a lot of driving. And since I've been coming back to Australia to talk about this topic in the last 2 or 3 years, I've said consistently, don't just focus on the carbon markets. You've got to focus on driving the renewables, driving the energy efficiency. They all are complementary at this point of the game. And investors respond extremely well to those signals. You build industries, you build green jobs, and you fulfill a very positive role in the economy. You're talking about investment growth and opportunities. So that remains our view. Great to see a carbon market, highly supportive, but don't underestimate the importance of the mandates and the standards. Just quickly on Copenhagen, look, these are the things they said they'd do. The big one that was missing was, of course, some big globally binding deal from 193 countries. They're all going to agree. Okay. So essentially Copenhagen, what did it really do? What Copenhagen really did was this. Between about October and February, 154 policies were enacted by governments around the world, getting ready for and coming out of Copenhagen. We don't think Copenhagen was the failure that it's put down to. It was still a catalyst. It still drew attention. It was somewhat depressing at times. But governments didn't go out of there saying, oh, by the way, the climate skeptics are right, I don't know what's going on, we didn't get a deal, we're heading back out to the hills. No, they said, okay, we've got to keep going. So you're seeing still a lot of policies being enacted around the Copenhagen Accord. I will put the big risk on here, and it would be wrong of me not to, budget constraint. For those policies that really just rely on government funding, there is no doubt there's a lot of strain in government budgets. But what we're tending to see is that the green elements are protected longer than many. And a lot of the policies we like don't actually affect the budget. They go straight into the consumer pays. So essentially, we still think the momentum policy backing is strong. Where are we at? We do all these calculations with Columbia University. We think business as usual at 2020 will be 59 gigatons of emissions. That's a disaster. So we need to get it down to about 44 to 46 gigatons. The mandates on their own, without any carbon emission targets, just mandates, will bring us down by 4 gigatons. If we could hit all the announced emissions targets, people could get what they've already said, we'll get down to 50. And if we sort of combine the best of those mandates and emissions targets, 49. Well, that's still a 3 to 5 gigaton gap if we get everything right. So it's not brilliant, but it's not bad. But the problem, do we have the incentivizing policies to get to all those emissions targets and mandates? Probably not. So we need to, that's why we keep pressing governments to give us more and more, not more and more mandates and incentives, but better designed and efficient ones. So I'll go through that one. So what do we think investors want? We think they want transparency, longevity, and certainty and consistency. We call this TLC. So if you look at economic theory, it'll tell you that if you create these three factors in anything, you'll probably reduce the cost of capital investors will invest. So where's an example of that? Well, what's been happening in Germany, I do represent a German bank, and we definitely think what's been going on in Germany has been fairly efficient. We've seen renewables in Germany go from 5 or 6% to double digits in terms of their share of the energy system, and the way they did that was through the feed-in tariffs. Now, recently, the feed-in tariffs create certainty for any given year, you know what your 20-year horizon is, but it comes down over time. And importantly, it comes down to grid parity over time. So what's happened recently, I believe that the German and European feed-in tariffs for solar have been so successful, the scale-up has been so phenomenal that the cost of solar PV has collapsed in the last 18 months. And the Germans said, you know what, we need to review that because we're not paying excess returns on our feed-in tariffs. So they did, and that caused a bit of controversy this year. But the truth is, our calculations show they've returned them to the same internal rates of return. They probably started off 3 or 4 years ago. The excess returns have dropped out. There are winners and losers, but these feed-in tariffs are still going to drive scale up in Germany. And what I point out is that they work. If you put something in place that causes scale, the prices will drop. And we will be at grid parity. Most people now expect grid parity against fossil fuels in big solar markets by 2013. So one thing we did do is we sort of looked at all these policy regimes around the world, and we did sort of rate them. And I'm not going to go into this in detail, except to say we were rather nice to Australia. We've sort of got a watch by it on this one. I think we've taken the watch off the one we'll actually publish. But I mean, I think we were very nice to Australia to say it was low risk. I won't go into it, but we sort of did. But we basically said the UK and the US were definitely sort of medium risk, but we've now put UK on an upgrade watch because they're looking at their feed-in tariffs more carefully. The United States, stop-start. So when you come to look at deployment of these technologies and how easy it's going to be, you know, CCS, it's going to be hard. Nuclear is not that easy. Agriculture and forestry, it's not that easy to do. Energy efficiency should be huge. But again, it's hard to push people to do it. We actually think the renewables, we know how to do them. You just put in these guaranteed payment systems and off they go. And gas may be becoming, question mark, this transition fuel, which is extremely easy to deploy. So, you know, how big can this sector be? You know, water, massive. Agriculture. We've got a whole paper on agriculture. I could go for a whole days on agriculture. Don't worry, I won't. But essentially, you know, climate change affects agriculture. God, I think Australia knows that, and or at least weather does. And essentially, you know, we're feeding 9.5 billion people. We wrote a paper. We struggled to work out how that works. So essentially, we think there'll be huge investment opportunities in there. And of course, you've seen the big run in the agricultural stocks already again. The significant amounts of cash in clean tech. The estimates are that you need between 400 and 500 billion and even up to $1 trillion a year to be deployed in clean energy markets. The IEA reckons we need about $10 trillion out to 2030 in these clean energy markets. So huge, huge infrastructure spending. Again, you know, solar, wind, biofuels. You know, these are going to get very big markets. Agriculture, again, we think you need to double agricultural production. You're going to be paying for some biofuels. We think that's a huge ask. And we keep asking, how are you going to do that unless you get big technology breakthroughs in agriculture? Water is, you know, some people think water is a much bigger problem than carbon, which is an interesting thought. Essentially, you know, the agricultural sector, again, playing a big role there in terms of the demand for water. But, you know, a lot of the data shows that we are running out of water in the right places. We probably got it somewhere on the planet, but it's not where it should be. So again, huge opportunities around infrastructure in water and technologies in water, desalination, filtration, etc. So just in terms of what happened in 2009 in these markets, in clean energy markets, actually they held on fairly well. The private equity VC market got hit the hardest, halved in size. What I found interesting is the most important, biggest market is the infrastructure build. That's called asset finance. That was only off 5%, and that's because China and the UK kicked in big in 2009 in certain of those projects. So, but that number needs to go from that, 150 to 200 up to the 500 level. So we've got a long way to go. Is there any signs of that happening? We've seen a turn in most of the flows in the markets. The PE VC market's begun to stabilize, tick up. Water, we think, is stabilizing. Agriculture is starting to bounce. Global project finance, as I say, we think held on extremely well. And it's very interesting, we all talk about China, but let's get this right. China is already the largest market for renewables in the world. So if I was to summarize our investment drivers, we're talking about climate change, energy security, economic recovery. We're talking about investing in clean tech sectors as an economic theme that provides an attractive source of alpha. So I'm about to move on to the investment markets. We are not asking you to do this because out of the good of your hearts. Nice idea, but we think you can make a lot of money. So we think resource prices are going to go up, and we think that's also going to be a catalyst. So one thing, the first point I'd put is a wider idea about how to invest in this. So I'm going to come on to specific products or strategies in specific asset classes. But there is a wider question. In a sense, as an equity investor, should you simply look at your total equity portfolio and decide how it's exposed to carbon? But to do that, we think you have to do that in a sophisticated way. You can't just take its exposure to just the amount of carbon footprint it has, because that depends on the regulatory environment you're in. I give this following example. You could be a coal utility in Europe that's brought a lot of cheap credits, and when the carbon price goes up, your stock price probably will. So you've got to understand your relationship to the regulatory environment. The second point is you've got to understand whether the corporate management is changing strategy. Is the new momentum going away, new products, and what the trend is there. So we have this system that we rolled out in Deutsche Asset Management. It was originally from a group called Innovest that got bought by Risk Metrics, that just got bought by, forgotten. But, everyone's gobbling this stuff up. That tells you something. The big players, they want into this market. So we actually have this available for the 300 billion equities that we run worldwide. We're capable of analyzing those equities in every portfolio in it, looking at their carbon exposures. So let's look at, so what can you invest in? Well, we think, it's public equity. We think that essentially public equity follows many of those sectors. We can find public equity companies to reflect mitigation and adaptation, and that's what Nick does in his world. VCPE, we've seen this is new clean technologies. We know this is a technology play, and we've seen clean tech funds starting up. We're seeing more of them, and we think that's an important area too. And then the area, as I say, I want to focus on is infrastructure, particularly from an Australian perspective. Now, when I worked in Australia, particularly in the 90s, I seem to remember Australia led the way in infrastructure. It's like I came back a couple of years and go, what happened? But nevertheless, Australia knows infrastructure well, probably the good and the bad. But I think this is a strong infrastructure play. But where I'm hoping it might be a little different is the fact that you are looking at predictable contracts in the power markets, whether they're through purchasing power agreements or they're through feed-in tariffs. So we think that's something to look at very carefully. And then finally, real estate. We have a large real estate business, a REEF, and it is looking extremely closely at how it greens its portfolios, the savings, how it makes its portfolio more efficient through going green. So I think all these areas have got opportunities to invest in. Just out of interest, we launched in the public equity markets, we launched an index in the last few weeks, and we launched it with NASDAQ, which is one of the leading names, of course, in technology. We call it the DB NASDAQ Clean Tech Index. So we use the word clean tech here, and it's got a little less agriculture as a result of that, but pretty much water and renewables as we know them. And, we showed that, from the market, this thing took off, and it's come back in the correction. What that tells you is there's no doubt that a lot of the public equity, particularly in renewables, is somewhat cyclical. It can be smaller cap, and it's seen as growth. So its beta is quite high. It does very well in up markets, tends to correct a bit in down markets, but seems to maintain its outperformance in many cases. We actually have subsectors, and what was very interesting, from the market low to the end of 2009, what's interesting is that energy efficiency led the way. So go back to my point about energy efficiency, and that was LED lighting. LED lighting is in big. Why? Because everyone gets the point. Governments are legislating out incandescent light bulbs. I mean, this is like an easy call, this one. So essentially the markets are building up momentum there. Clean energy was quite strong. Water tends to be a little bit more defensive, as does waste management. But during the correction, water holds up a bit better, and energy efficiency held up very well during the last couple of months when there was something of a correction. So essentially, what I'm going to show you, think about it. In our climate change universe, the number of Australian stocks is not great. Let's just be honest. This is a global play in international companies for an Australian manager. Therefore, the currency, is going to have an impact on how well that goes and whether you need to hedge it also. So I just want to make that point. But in doing that, what I really want to say to you, think about this. Is an investment, particularly in renewables and clean energy, a global diversification against the Australian mining sector? So the Australian mining sector is massively energy intensity from all fossil fuels, right? So if that comes under pressure, by definition, those clean energies have to be filling that gap or it's not coming under pressure. It's just one or the other. So I think there's a sort of interesting hedge proposition for you guys. It's offshore and it probably hedges particularly coal until CCS, and if CCS gets going, which is, I think, a way off before anyone truly believes that. So what we did is, just out of interest, we ran, I think, a model portfolio we took from the industry funds management surveys. We looked at historical returns, historic volatility. We inserted some of our climate change sectors into that: water, agribusiness, energy, and so on. We took it across asset classes. This is impossible to read, I realized when I got on the plane, apologies. But what we basically did is we said, look, if we triple the weighting in climate change across infrastructure, public equity, and private equity, then we probably boost the mean portfolio by about 40 basis points, which is not bad in these markets, and that's only a 6% weighting in the story, and we raised volatility a little bit. So again, we tried to do a simulation, more not because anyone's going to do this, but to make the point that these climate change sectors give you an alpha performance. They do not improve your diversification so much. They do not lower the correlations. They are reasonably correlated, but they do seem to contain a lot of historic alpha.